Insurance. Okay, I know it's probably not the most exciting word you'll hear today. For most of us, it's just another bill, right? Another piece of paper to file away. But what if I told you it's actually one of the oldest, most powerful ideas in human history? That it's less of a financial product and more of a 4,000-year-old story about community, risk, and our deep, fundamental need to build a secure future. Let's dive in.
It sounds like the start of a really weird joke, doesn't it? I mean, Babylonian traders, pirates on the high seas in the 1300s, and you just trying to drive to work. What on earth could possibly connect all of them? Well, the answer is this brilliant, surprisingly simple idea that we're going to unpack.
Here's the thing about life. It's uncertain. Always has been. A fire, a storm, a sudden accident, a single stroke of bad luck can wipe out everything a person has worked their entire life for. And for as long as that's been true, we humans have been trying to figure out a way to fight back against that uncertainty. The solution we came up with? Well, it's deceptively simple, but it changed everything.
To really get this big idea, let's zoom all the way in. Just picture this. A small village, 400 houses. Each house is the family's most valuable asset, worth about 20,000 rupees. Everything's going fine, but everyone shares this one nagging fear in the back of their minds, the risk of a fire.
Now, let's say statistically about 4 houses in this village burn down every year. For those 4 families, it is an absolute, undeniable catastrophe, a total financial wipeout. That 80,000 rupee loss is slammed onto just a few unlucky people, while everyone else is fine, at least for now.
But what if they decide to face that risk together? What if every single one of those 400 homeowners puts a tiny amount, just 200 rupees, into a shared pot? Well, all of a sudden, they've got 80,000 rupees sitting there. So when those 4 houses are lost, the funds can pay the owners back completely. And just like that, boom, the problem is solved.
And that is the magic trick right there. It's a principle called the law of large numbers. By pooling their resources, the villagers took a life-ruining disaster for a few people and transformed it into a small, predictable, totally manageable cost for everybody. That little 200 rupee contribution? That right there is the world's simplest insurance premium.
Okay, so we've got the basic idea down. Spreading the risk. Simple enough. But how did this little village concept blow up into the massive global industry we know today? Well, for that, we've got to jump into the history.
The roots of this thing are ancient. I mean, we're talking way back, 2100 BC. Babylonian merchants had ways to protect their goods on dangerous trade routes. But the real game changer, the first time it was all written down, was in 1347 in Genoa. Then, major disasters like the Great Fire of London in 1666 created a huge, sudden demand for insurance. And it all came together in the most unlikely of places, a simple London coffee house where merchants met, which eventually became the legendary Lloyd's of London. Let's just pause on that Genoa contract for a second, because this document was the blueprint for everything that came after. Think about it. Genoa was a shipping superpower, but sending a boat full of cargo out on the open sea was a massive gamble. This contract was a formal promise. You pay us a fee, and we promise to cover your losses if your ship gets smashed by a storm or, yes, gets attacked by actual pirates.
And what's just mind-blowing is how modern this nearly 700-year-old document feels. It had all the pieces we recognize today. The shipowner paid a premium, the insurer promised to pay compensation if things went bad. It even clearly defined the scope of risk, what was covered, and the insurance period. It has the exact same DNA as the policy you have for your car. Incredible.
So, you've got this great system. But for it to really work, for people to actually trust it, you need more than just a piece of paper. You need some ground rules, a set of principles that everyone agrees to play by.
You know, in most business deals, the motto is basically caveat emptor, right? Let the buyer beware. It's on you to do your homework and not get a bad deal. But insurance is different. It's held to a much higher standard, one called uberrima fides. It's Latin, and it means utmost good faith.
And this is absolutely crucial. It's a two-way street. It means that both you, the person buying the policy, and the company selling it have a duty to be completely, totally honest about all the important facts, even if you're not specifically asked. It has to be built on a foundation of complete transparency. No hidden cards.
The other big rule is something called insurable interest. It sounds a little technical, but it's really simple. It just means you can only insure something if you'd actually lose money if it got damaged. It's the reason you can insure your own house, but you can't secretly take out a fire insurance policy on your neighbor's house. You've got to have some real skin in the game.
All right, so we have the core concept, and we have the principles of trust. Now, let's see how this whole thing evolved from individual deals into a massive, regulated industry that would go on to shape entire nations.
And you know, there's no better way to see that evolution in action than by looking at the story of insurance in India. It's a fantastic case study of the whole journey, from the early days to state control and finally to the open market we see today.
So the first modern insurance company kicks off way back in 1818. But the really big shift happens in 1956, when the government steps in and nationalizes the entire life insurance business, creating the giant we all know as LIC. They did the same thing for general insurance, car, home, etc. in 1972. Then, fast forward to the year 2000, and the pendulum swings back again. The government opens the doors, letting private and foreign companies back into the game.
And you can really see that opening up trend right here. When the market first reopened, foreign companies could only own about a quarter of an Indian insurer. By 2015, that jumped to almost half. And just a few years ago, it shot up to 74%. That's a really clear signal towards a more global, more competitive industry.
So, after this whole journey, from ancient traders to modern-day markets, why does it all matter? Because that simple, powerful idea of pooling risk is now the invisible safety net holding up our entire world. It's what lets companies ship things across the globe, what lets people start new businesses, and what lets us own a home or a car without being terrified that one accident could ruin everything.
And that brings us right back to the beginning. When you read this formal definition now, it's not just some dry textbook sentence, is it? You can feel the weight of thousands of years of human ingenuity behind those words. It's a promise to make the unpredictable manageable. Think about it. The first insurance policies protected us from pirates and fires. Today, they protect nearly every part of our lives. But what's next? In a world of cyber attacks, climate change, and risks we probably can't even imagine yet, what new forms will this ancient, powerful idea need to take? What will be the pirates of the 21st century? And how will we build a safety net for them? Now that is something to think about.